Welcome to Talk Tickers. Today, we're jumping into the latest McKesson earnings call.
That's right.
Our goal here is really to break down all the numbers, the strategy talk, give you the key takeaways on how this healthcare giant is doing and, where it's pointing next.
Yep, we've got the report, the transcript, ready to dig in.
All right, let's kick off with the highlights. How did fiscal 2025 shape up for them?
Well, they finished really strong. Record full-year revenues, hitting $359 billion.
Wow, $359 billion. That's quite a number.
It is. And it's a big jump, too, up 16% compared to the year before. Profitability was also better than expected.
Okay.
Adjusted earnings per share for the full year landed at $335. That's up 20% year over year, and actually above their own long-term targets.
So impressive growth, top and bottom line, sounds pretty positive. What about cash flow and shareholder returns?
Yeah, they generated strong cash flow all year. And they were active returning capital, about $3.5 billion total.
Oh, yeah.
Both share buybacks and dividends. So, it signals they're financially healthy and pretty confident.
Makes sense. Okay, looking forward then. What's the guidance for fiscal 2026?
They're expecting that momentum to continue. Revenue growth projected between 11% and 15%.
Still double digits, eh?
Still double digits.
Yeah.
And adjusted earnings per share, they're forecasting $36.75 to $37.55. That works out to 11% to 14% growth over this past year.
Okay, so the trajectory looks good. Now let's get beyond those headline numbers. What were the really key strategic pieces they talked about on the call? What stood out?
I'd say a major theme was definitely their push into oncology and biopharma services. They seem to be really accelerating there.
Right.
They mentioned completing the acquisition of a controlling stake in Prism Vision.
Prism Vision, that's the ophthalmology one.
Exactly. Ophthalmology and retina management. So a clear step into strengthening their position in, specialized medical areas.
And wasn't there another deal cooking in oncology?
Yes, precisely. They've got a pending deal for a controlling interest in Core Ventures.
Core Ventures, what do they do?
They provide business and admin services, basically, for community oncology practices. That deal's set to close really soon, like June 2nd.
Okay.
And it's expected to add about 530 providers to their U.S. oncology network. So it's a pretty significant expansion in cancer care.
That is a big boost. Any other strategic points they hammered home?
Well, they talked about continuing to invest in their core distribution side, technology, infrastructure upgrades.
The nuts and bolts.
The nuts and bolts, yeah. And also launching initiatives across the company to modernize using tech, automation, even AI. Seems like a focus on efficiency and, staying ahead.
And the really big strategic news, maybe, the separation.
Ah, yes.
Yeah.
That was definitely major news. They announced they intend to separate their medical surgical solutions segment.
Spin it off
into its own independent, publicly traded company. It's a pretty clear signal they want to focus their capital, their energy, on those higher growth areas we mentioned, oncology and biopharma. Okay, that's a big shift. Let's dive into how the segments actually performed this past year. Starting with the biggest one, U.S. Pharmaceutical.
Right. U.S. Pharma had a very strong Q4, revenue up 21%.
21%. What drove that?
Mainly prescription volumes from the big retail chains, their national accounts, and also significant growth in distributing specialty drugs.
Specialty
like oncology meds, and definitely those GLP-1 medications everyone's talking about. For the full year, U.S. pharma revenue was up 16%, and operating profit grew by double digits, too.
You mentioned GLP-1s again. They seem unavoidable these days. How big are we talking?
Well, just in Q4, GLP-1 revenue was $10.9 billion.
Billion, with a B.
Yep, which is up 46% from the same quarter last year. Although, interestingly, it was about flat compared to the previous quarter, Q3.
Still, 46% year-over-year growth is massive.
Absolutely. Highlights just how big the demand is for those diabetes and weight management drugs.
Okay, let's shift to Prescription Technology Solutions, or RxTS. How did that segment do? Also strong results there. Q4 revenue up 13%, and operating profit jumped 34%.
Wow, 34% profit growth. What's behind that?
It was driven by higher prescription transaction volumes, specifically things like their access solutions, basically helping patients with insurance, affordability, and prior authorizations, including, again, for those GLP-1s. Plus, they had a good annual verification season, full year profit growth. There was also double digits.
Got it. Now, Medical Surgical Solutions, the segment they plan to spin off, how did it perform in fiscal 25?
A bit more modest on the top line in Q4. Revenue was up just 1%.
Only 1%.
Yeah. They saw some growth in specialty pharma within that segment, but it was offset by lower volumes in primary care. However, operating profit was actually up 15% in the quarter.
15. How'd they manage that with flat revenue?
Mostly through cost optimization efforts, it seems. And looking at the full year, they did point out this segment has shown solid growth since fiscal 2019.
Right, okay. And wrapping up the segments, international.
International Q4 revenue was down 2%, mainly because they sold off their Canadian retail pharmacy businesses, Rexall and Well.ca.
Ah, divestitures.
Exactly. But interestingly, operating profit for international actually went up 9% in the quarter.
How?
Driven by higher volumes in the Canadian pharmaceutical distribution business they kept.
Okay, so a bit of a mixed picture internationally due to those sales, but the core U.S. businesses look really strong. Let's pivot back to the outlook for fiscal 26, but at the segment level. What are they projecting for U.S. pharma?
For U.S. pharma, they're guiding for 12% to 16% growth in both revenue and operating profit.
Still very strong.
Very strong. And that includes expected contributions from those acquisitions we talked about. Prism Vision is pegged at maybe 20 to 30 cents per share contribution.
Okay.
And Core Ventures, the pending one, at 40 to 60 cents per share. And maybe most importantly, they actually raised their long-term adjusted operating profit growth target for U.S. pharma.
Oh, to what?
To 6% to 8%, up from before. So that signals real confidence in that core business going forward.
That's a definite vote of confidence. What about RX Technology Solutions for FY26?
They see revenue growth there between 4% and 8%, and operating profit growth of 9% to 13%.
A little slower on the revenue side, maybe?
Yeah, they mentioned expecting slower growth in what they call 3PL volumes, think outsourced logistics. But they said demand for their access and affordability solutions remains really strong, and their long-term profit growth target for RxTS is still quite high, 11% to 12%.
Gotcha. And for medical surgical, given the planned spinoff, what's the FY26 guidance look like?
Well, the guidance they gave assumes they still own 100% of it for the whole fiscal year.
Okay, so pre-spinoff numbers.
Right. And on that basis, they're projecting 2% to 6% growth for both revenue and operating profit for MedSurg.
All right. And international, what's the outlook there?
Kind of a wide range. Revenue could be anywhere from down 2% to up 2%. Operating profit expected basically flat, maybe down as much as 5%.
Why the uncertainty?
It reflects, continued growth in Canada being offset by those prior divestitures.
Yeah.
Plus, they're planning to exit their business in Norway.
Okay, lots of moving parts internationally. What about the corporate level view expenses, cash flow for FY26?
They're forecasting corporate expenses around $570 to $630 million. Interest expense, $255 to $275 million. Tax rate expected between 17% and 19%.
And cash flow, buybacks.
Strong free cash flow expected again, $4.4 to $4.8 billion. And they plan to use a good chunk of that, about $2.5 billion, to repurchase shares.
Okay, so it definitely sounds like they've got a plan, leaning hard into those growth areas. Stepping back, what are the big themes, the key insights you took away from the whole call?
Well, first, you just can't ignore the continued strength in specialty pharma, especially oncology and those GLP-1s. It's huge.
Right.
Second, the strategic acquisitions Prism, Core Air show a really targeted approach to building strength in specific specialized healthcare markets.
Oh.
Focus, exactly. Third, the MedSurg spinoff plan really underscores a disciplined portfolio strategy, doubling down on what they see as the higher growth, higher margin stuff.
Makes sense.
And fourth, there was a consistent emphasis on operational efficiency, using technology like AI, managing costs. And overall, you just got a sense of real confidence from management about their momentum and hitting those long-term goals.
Did they address any potential headwinds, like regulatory risks or tariffs?
They did touch on that.
Okay.
Specifically, potential changes to Medicare Part B pricing and also tariffs.
And the takeaway?
Basically, management said based on what they know now, they don't see any immediate material negative impact on their guidance. They argued for fair compensation for community care and believe they can get fair value for their services. And on tariffs, they pointed to diversified sourcing as a mitigator.
So acknowledge the risks, but not baking in major problems yet.
Pretty much, but definitely things to keep an eye on.
So boiling it down for someone tracking McKesson, what are the absolute must-knows from this?
Okay, number one. The MedSurg spinoff is a major strategic pivot towards pharma distribution and biopharma services, the higher growth, higher margin parts of the business.
Got it.
Number two, the FY26 guidance is strong, beating their own long-term targets, which shows significant confidence.
Okay.
3, Watch the continued expansion in oncology and now ophthalmology. That's where they're placing strategic bets. 4. GLP-1s are a massive tailwind, not just for drug distribution, but also for the tech solution side, helping patients access them.
Right, the access piece is key.
Exactly. And finally, while they're downplaying regulatory and tariff risks for now, those are still the external factors you need to monitor.
Excellent summary. Okay, time for our favorite speculative segment. This is not financial advice. Based on all this McKesson chatter, what's a wild but plausible trade idea bouncing around your head?
All right, let's brainstorm here. Purely hypothetical, of course.
Of course.
Given McKesson shedding the MedSurg business to double down on pharma and biopharma services, which generally command higher valuations, maybe you consider a pair trade.
Okay, like what?
Like going long McKesson, betting on that focused growth story in pharma and tech, and pairing it with a short position against, say, a major pure-play medical vertical distributor. Or maybe even a MedSurg supplier index.
So the idea is McKesson gets rewarded for its focus, while the separated MedSurg business or its peers might face different market dynamics or slower growth.
That's the thesis, yeah.
Oh.
The market might increasingly differentiate between McKesson's trajectory and the prospects for the more traditional MedSurg space. Again, total thought experiment, not advice. Do your homework.
Definitely not advice, but an interesting thought experiment based on the strategic direction. So that wraps up our deep dive into McKesson's latest earnings call.
Seems like they're making some pretty decisive moves.
For sure. Focusing on those high-growth healthcare segments, planning the MedSurg separation, investing in oncology and biopharma. Lots to watch there. What do you think about their strategy? Is the spinoff going to unlock value? Let us know your thoughts.
Yeah, join the conversation.
This has been Talk Dickers, bringing you the key insights from earnings calls. And remember, nothing you heard here is financial advice. Always do your own research.